Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about when to consider financing a purchase when you can afford to pay for it in cash. And so we'll talk about hey, what types of transactions might that be applicable to? What's kind of the cost, you're thinking through the cost of financing and variable interest rates, potential tax considerations. Justin, I think this is fun because this is something where most of my professional career, it hasn't really been a conversation. And I feel like in the last 2 years, we've gotten more questions about it because interest rates are up, right? For the past decade or so, pre-COVID, pre-2022, interest rates were flat. And so it was a pretty easy conversation in my mind. The math, the one group of people that are optimizing the math see, hey, I can borrow at the rate of inflation. Why wouldn't I just borrow everything and hopefully invest it and earn more on it? And then, of course, the debt averse people where even if interest rates are really low and it makes sense on a spreadsheet to finance, they just don't like the idea of debt, so they pay it off anyways, right? So really it seemed like the answer was pretty clear when the interest rates were 2%, but now that they're at a more normalized rate, we seem to be getting a lot more of those questions.
Jared, that's absolutely right. And you mentioned debt averse. So I would almost tweak what you said a little bit and say that we're now in an environment for the first time in a long time where it is a little bit of a math equation and trying to figure out an optimization equation. Prior in the prior kind of universe of low interest rates that lasted for a really long time, it was purely what's your relationship with debt and what do you want your relationship with debt to be? To be clear, staying out of debt and avoiding debt is a terrific thing. There's nothing wrong about that at all. That is a good thing. But that was really the extent of the equation. You finance something if you want to optimize return and you can duration match with what you're trying to do, or you pay it off in cash and you avoid debt, which is largely out of a principle to avoid debt or just really keeping risks and mind share low on it. And so we are in a different universe today where the comparison is just a lot more weightier. And there's a lot more kind of math at stake here.
Yeah. And I would argue the behavioral life component equation doesn't go out the window, right? If you're debt averse, it could still make sense to pay off the debt, even though it's not financially optimal after you've run the equation, right? We don't ignore the life component. It's no longer the only variable we solve for.
Yes. Well put.
Justin, I think before we were talking about this, you mentioned something that I think is worth delineating and clarifying what we mean. Cause we're talking about when to finance, when you can afford to pay cash, right? Which is that's the question we get a lot from our listeners, which is very different than how I think about leverage, even though leverage and financing are kind of synonyms. So how might you, for the purposes of this conversation, how might you delineate, financing when you can afford to pay cash versus the idea of leverage?
Yep. So I think that it's largely what we want to spend this podcast talking about is should you finance or should you pay cash if you have ample cash to allocate. And so if you're talking about a purchase decision or an investment decision where you have plenty of resources to make it happen, and it's just a matter of, hey, do we want to leverage this a little bit or do we want to pay in cash right on day one? That's kind of what we're hinting at here. And so, Jared, internally, the team today, we talked a little bit about just some of the, update with Airbnbs really struggling. So we had a podcast, 3 years ago that really predicted, and we don't like to predict things. This turned out to be a pretty good prediction. We predicted that, hey, investing in Airbnb real estate is going to be an uphill battle. It's not going to be remotely similar to what it was like in 2018 to 2021. There was a tweet, housing bubble disrespecter, was quoting kind of a video from someone saying, hey, our Airbnb is not renting out at all. And his quote said, why would I pay $200 a night for a cabin in the middle of nowhere? And so to kind of paint the picture there, it is interesting. And I actually do want to mention this before we get into our main topic. Jared, when you are investing and you're going to use leverage, you better duration match that leverage to the investment. And so some of the Airbnb going belly up and really not working in the past few years, well, part of it, you kind of go back and you're thinking, one, is there going to be 30-year demand for this property? If it's a basic, rental in a college town and the numbers clearly work, yes, there probably will be 30-year demand. If it's a cabin in the absolute middle of nowhere that you're going to turn into some Airbnb paradise, is there 30 years of demand? No, there's a good chance that there's not, right? And so I do think that when you just look at, hey, should I finance an investment? Should I add leverage? Should I add debt to an investment? You do have to really figure out, does this investment have a high likelihood of having demand and being a viable investment for the duration of my, debt instrument that I'm going to use to purchase it? But, I think this conversation wants to instead focus a little bit on the resources are there, the cash is there, and you're asking the question, should I just simply sell some of the other liquid investments and allocate, or just simply take cash from point A to point B and pay for this investment in cash, or should I use financing? And so where should we go from here?
Yeah, leverage financing, very different. So financing when you have the cash. Leverage is really amplifying your results, both on the upside and the downside, using cash you don't presently have, right? Which is very different outside of the scope of this conversation. So Justin, let's start with interest rate, right? Like what would you say about because that's like when you're financing, that's the big thing is you are paying a cost for borrowing. How should people think about this cost for borrowing? Like overly simplistically, the higher the interest rate, I would say, the higher the odds that you should pay cash, right? Because the cost of borrowing increases. But what nuance or clarification would you add to that idea?
I'm almost struggling as to where to start with it. Because every single allocation or investment probably has a little bit of a different answer. And maybe one place to start is this purchase decision. How much of this is consumption versus how much of this is investment? Is it purely on one of those spectrums? Is it purely consumption or purely investment? Or is it a mix? How about you, Jared?
Yeah, I mean, I think that's a good place. It's like, okay, what am I spending it on? But instantly I go to so I know the cost, but 2.0 is okay, the cost is the interest rate. But I think about, okay, what is the after tax cost, right? And there's and we'll talk about this here in a minute, but different types of debt have different tax consequences, right? So when it's kind of like an illustration of, hey, what are returns? It's okay, what are investment returns? Okay, that's a helpful number. Much more helpful number. What are investment returns net of fees and net of taxes, right? Because those are the only returns you can eat. So I think thinking about interest rate is the same way. It's okay, what is my after tax cost of borrowing? And then also, how do I think about my net cost in terms of where am I pulling this cash from and what is this cash earning? Right? Because there's an opportunity cost of, hey, if I'm pulling this cash from a high yield savings account and it's earning 4%, the net cost looks a little different than if I'm pulling it from a long-term equity portfolio that might have, low double digits, 10-ish% and in a future annualized expected return. So, I mean, that's the first thing I go to.
Jared, I think there's a really good, that's a fantastic thought. A couple different tangible examples that could be interesting here. Let's say that you are someone who has a really healthy emergency fund that's just beyond what you have to have. So let's say that, you've got 200,000 in cash in a high yield cash instrument making 4.5% per year. But there's really not any sort of academic reason for you to have more than 100,000. And if you are going to go purchase a car, and let's say that you're asking the question, should I finance the car or should I pay cash? Well, there's some tax questions on both sides of the equation. So you mentioned, if you go buy something and you finance it, well, are there tax implications with financing whatever you purchase? For example, you buy a house, real estate of some sort, and you could potentially deduct the interest that you pay on it. There's also on the other end of the spectrum, go back to the car equation, Jared. So let's say you have 200,000 in a high yield checking account. Well, what if you make $1 million a year and you're in the highest tax bracket? And that 4.5% high yield on that 200,000, all of the income that spits off is being taxed at a high rate, right? And so then the question becomes, well, actually, it's kind of beneficial, especially if you can't get a really advantageous interest rate on the vehicle, to simply pay cash for the vehicle, because the high yield that you're getting, well, it's not even as high yield as you think it is, because you've got to pay a bunch of tax on said yield. And so there's kind of both ends of the spectrum, thinking through the ramifications there.
And I mean, again, it's highly personalized, right? There's different, like getting back to kind of what you're talking about of like the tax considerations, like there's also a timing of cash flows consideration, right? Like in that scenario you outlined, if I have $1 million income, but I'm retiring in a few years, maybe I finance it for the next 2 years and then pay it off using portfolio income when I'm in substantially lower income tax brackets for IRA distributions or cap gains tax brackets, right? So like, it's also a function of yeah, hey, what does the math say if I look on the balance sheet? But also like, it's not a stagnant decision. What does your situation look like over the life of this loan?
Absolutely. And you hinted at this earlier, Jared, but if the source of capital that will pay for whatever you're thinking through, if it's in investments that have really large embedded gains, that totally changes the equation. Maybe you're either not paying cash or you do exactly what you just mentioned. You play it out for a few years. You wait until income is in a lower bracket, and then you can strike.
Yeah. So there's really taxes on two sides of the equation. Hey, what's the cost? There's cost on two sides of the equation. What's the cost of borrowing? But then also, what is the after-tax value that I'm receiving of the investment when I'm comparing those trade-offs? Justin, I think it's worth like delineating, because really like in my mind, there's two types of financing. Like I would say obligation specific, i.e., like I'm buying a car or I'm buying a bike that's really expensive and I can finance that specific asset. That is a secured asset. But then there's also like secured lines, right? Like what I call these dry powder, right? You can tap them at whatever interval you want, right? And of course the interest rate equation fits into that. So like secured lines, dry powder might be, margin on an investment portfolio, 401k loan, HELOC, right? So like typically with those secured lines, and okay, this is overly simplistic, but secured lines have a higher interest rate than like obligation specific financing for a couple of reasons, right? It's, there's less volatility in the collateralized asset generally. And then also too, the financier is often the person selling it. So they might have incentives and they might be able to go below market to get the transaction done. So like with obligation specific financing, I'd say you could generally get a better rate. But like one of the things that's good about secured lines, like having the dry powder, it allows you to be opportunistic and know you have the asset if you need it, but not necessarily tap it. And then you only pay for interest when you need it. The interesting thing with, like if you borrow the cash, you might not necessarily need it. You could pay it, but having a secured line kind of gives you the flexibility. So like, I think like also kind of delineating, hey, I know the interest rates are going to be different. And it's also important thinking about, okay, what's my net cost, but also like what type of financing would I want and am I comfortable with? And what are the trade-offs that might exist between those two? What would you add to that?
Yeah, I think that kind of gets into a different web of decisions and opportunities. Just thinking through, okay, are you going to get access to some kind of alternative lines of credit? And whether that is just a margin loan through your brokerage account or a unique instrument that's available. And so the types of financing that you can pursue can play a huge role in this. Gosh, I mean, Jared, there's so many moving parts here, because it's almost like you have to forget about, we mentioned taxes. Forget about taxes, first of all, and just ask the question investment wise, what's the opportunity cost of what we're doing here? What is the opportunity cost of selling an investment that you're in now in order to purchase whatever you're purchasing? And those are wildly different if it's a diversified portfolio, or obviously it's, wildly different if it's a privately held business that has a reasonable chance of compounding at 20% a year for the next decade. And so, yeah, it just feels like there's a million different kind of exit ramps that we could take with this discussion.
Yeah. And even too, right? Like getting back to opportunity cost, right? Overly simplistically, the 60/40 portfolio, which for reasons we talked about in previous episodes, is an overly simplistic benchmark that isn't helpful, but it's everybody's bogey, right? The 60/40 S&P Treasuries annualized return of about 8% over the last 100 years. So if I'm pulling from an investment account, if I'm pulling from an investment account that we're invested in that at 8%, to potentially finance at a rate that's lower than that, you could argue, ignoring taxes or anything else, the opportunity cost is pretty high. But again, if you're using cash on hand that's in a high yield account that's paying 4% before any taxes, that the math on the delta between those two is different. So they, should almost be treated differently. But Justin, the problem is that even, which bucket you pull from matters. Because like if I were to pull that out of a Roth IRA, yeah, there's no tax consequence today. But if that means my balance, I'm missing out on all that tax-free growth compared to a pre-tax IRA or a taxable brokerage account or a money market account, that also is a legacy asset that changes the composition of my balance sheet, decades down the line. So there's a lot of phantom costs that aren't, that matter, that aren't perceived at the surface.
Jared, this also makes me wonder, did you ever watch the Apple TV show on WeWork?
I did, yeah.
Okay, so awesome show. I would plug it. I would recommend that anyone watch it. It's super entertaining. And the entire story of WeWork is just so fascinating. And, I want to pause to say this can just be a little segment in the podcast where we pause. And Jared, I'm just so thankful that we're no longer in a WeWork. But WeWork, when you look at that TV show, they kind of go into this, that Adam Newman was effectively getting private debt instruments offered to him with his stake in privately held WeWork stock, which is kind of crazy to think about because he's using a debt instrument to buy mansions all over the world. And in theory, so I guess the principle behind this is, hey, this privately held stock has compounded at 30% a year for many years now. Therefore, why in the world would I ever sell my stock to buy this $10 million home if I can just go to JP Morgan and they can create a, private debt instrument to allow me to borrow against this? And so kind of amazing how many creative ways you can use debt if there is kind of a backer behind it willing to create it.
Yeah, that's right. But proceed with caution, right? Kind of financing amplifies return and risk. But again, in this scenario, I would say an oil and gas professional choosing whether or not to finance a car that they could afford to pay in cash is a little different than Adam Newman's WeWork empire leverage to illiquid private company stock.
I will also say this, kind of genius by Adam Newman to go ahead and do this because WeWork stock obviously cratered, it plummeted, and he went and bought all this real estate all over the world right before real estate, doubled or tripled in value. So quite the play by him. I don't think it's really repeatable though. So I don't think there's any sort of investment path that you should follow there.
Yeah, maybe what not to do. And especially with the risk aversion of our average listener, I'd probably say more very entertaining. Not much financial wisdom in there.
That's right.
But yeah, so I think we're talking about costs, right? So after tax cost of borrowing, some of the types of debt that might have potential tax advantages. So mortgage interest, student loan interest, business debt, and we could get into a whole thing. That's a whole nother thing, like SBA versus line of credits, all that stuff. HELOCs and margin on a portfolio, and the types of income offset and the limitations. There's a bunch of different rules, but all of those types of interest can potentially have tax advantages. I would say a lot of consumer interest, like cars, credit cards, buy now, pay later, like none of like generally no tax advantages there.
Yep, for sure.
So I would also say like we're talking about cost. And the other thing I think like we hinted at this, but okay, what does purchasing versus financing mean for incremental distributions on the portfolio, right? Like we've talked about this idea in past podcasts, but like there's income cliffs, right? Like i.e. like if I'm like IRMA brackets, if I'm $1 into the next IRMA bracket, my Medicare premium could increase, over $1,000. Like if $1 gets in that bracket. If income tax rates are marginal, so if I hit the next bracket, only that dollar subject, right? So sometimes there's certain tax brackets that we would call cliffs, right? Where if you hit it, you're punished for it. And so like I would also think this plays a part in thinking through the cost of like, hey, if I paid cash or if I paid cash and I needed an IRA distribution to do that, what would that do to my income? Right? Like maybe if I finance it and still pay with that same IRA distribution, it still keeps me below that income cliff. Right. So in that scenario, you might look at the interest rate and say, hey, no way to do that. But then you might look under the hood and say, hey, what does that do to my actual income picture? Oh, it subjects me to a bunch of different taxes, whether it be net investment income tax or an increased IRMA bracket or an increased marginal tax bracket or a phase out of some certain credit you might be taking for healthcare, right? There's really a web of things that need to be considered. But understanding this idea of like, hey, what does the incremental distribution mean for my portfolio? And thinking through, okay, how's my income changing? What are the cliffs I need to be aware of? And what are kind of the flags in the sand that I need to try to be mindful as I'm thinking of do I pay cash or do I finance?
That's right. And even if you finance, you may have not used the resources yet. But Jared, to your point, you're going to have an ongoing carrying cost because of that debt instrument. And in order to meet your obligations there, you may have to realize more income somewhere else in your balance sheet. I would also piggyback on this. And Jared, this is probably one of the most textbook cases that we are working on for clients. I mean, on a monthly basis, like several times a year, we're thinking through this question. And it's not necessarily having to do with, okay, next tax bracket, next IRMA Medicare premium bracket, capital gains brackets, but it's almost more what's your entire tax plan or your entire tax situation. And if you are wanting to pay off your house before you retire in retirement, or if you're wanting to pay off your second home, what is the opportunity cost? Because Jared, I mean, you're probably using non-retirement brokerage assets to do this. And what assets do you must have? What are must-have assets if you're trying to execute capital gains harvesting, Roth conversions in the early years of retirement? It's those non-retirement brokerage assets. And so another way to think about this, if the payoff number is 500,000 to pay off your house, but that is going to eat up the vast majority of your non-retirement brokerage dollars, you've got to ask the question, would it be better spent on 2 to 3 years of living expenses plus Roth conversion tax bills? And, there's going to be a short-term answer to that, but the much bigger answer with huge ramifications is what is the 20 to 30 year outlook on those different tax decisions like Roth conversions that are not going to be able to be done at the same level if you pay off your house.
Yeah. And like, I want to pivot here because like we've done a good job. I mean, not really answering the question, but outlining all of the explicit and implicit costs that go into thinking through and opportunity costs that go into thinking through, okay, do I finance? Do I pay? But like we talked about these people at the beginning of the podcast, but like there's some people that have like a debt aversion. How does that fit in all this, right? Like how do we think about like the mind share trade-off or like the energy cost or like the mind share cost? Like, is it worth having a liability and line item on your balance sheet? Like, even if it's financially optimal, right? Like, okay, you could finance, like you bought new furniture and you could finance it at 1% over the next 24 months. Like, yeah, you could earn a spread by investing that in treasury bills or, even a high yield savings account earning 3.5% and definitely make money. But then you got to set up auto pay, and then you have a liability on your balance sheet and you got to make sure it gets paid. And then it's just another thing to think about and operate, and then that exists in your financial ecosystem. So like if you buy a $3,000 couch and save like 2% on that, you're definitely making money, but is it worth the energy you spent thinking about it?
That's right. And I do think every person has to answer that question individually. And I think it's really smart to just have an answer of no way, I am not adding any complexity to my life. Quick example, and this isn't even complex for crying out loud. But Jared, we just, we bought a new home recently, right? And so we have had to buy some furniture to put in said home. And we are just hit up with this, enormous cashback Pottery Barn, whatever, if I sign up for their credit card. I don't care what the cashback is. I don't care how great the reward is. I don't even want another login to anything. I don't want to spend the 30 seconds to give you my information to do it. It's not worth the hassle. And so, yeah, I think everyone should feel the freedom to just say, we don't have to optimize everything. We can keep things simple and then kind of have, a little bit of a barometer. So one, it's okay if you don't want to optimize anything and you want things to be real easy and you want to be debt free. I think that's a great idea. There's nothing wrong with that. But if you're kind of on the fence, Jared, then, you've got to do some analysis back to, should you pay off your house? Or let's say you're retiring and you're going to move. So the question becomes, how much house should I buy? Or you're retiring and you want a second home. You've got to figure out, okay, what exactly would I be giving up here if I go, make this purchase in cash? And what exactly are the value of these Roth conversions that I'm not going to be able to do? So that's a straightforward, calculation that you can begin to get an idea as to, okay, what is this looking like in the first 5 years? What is it looking like in 25 years? But you're absolutely right. You have to weigh and measure, hey, is it worth the hassle?
It's funny because everybody has a different answer. You said Pottery Barn credit card, and my ears perked up. Like anyone who knows me knows, like, I got a stack of credit cards. I'm constantly scheming, sign up bonuses, figuring out, okay, if I book an American flight, but I book it through British Airways portal, it's actually cheap. So it's like, and I realize it's totally a dilutive game and it's not worth my time, but like the thrill of the hunt, there's going to be a subset of our listeners that, say, hey, if I could finance it for free and put that in a high yield savings account, even if it's tens of dollars, makes you feel like you stuck it to the man. So I want to show solidarity to those people. And yeah, people are on a spectrum, right? And I think it's just another ingredient in the soup of thinking about this. So Justin, in conclusion, right? Like really, I feel like we answered the question like any financial planner would, is like, hey, should I pay cash for this? And it's like, okay, well, it depends on your implicit and explicit costs of borrowing and what are your trade-offs, right? And we gave a framework for thinking about that. But if you had to like summarize, just like Cliff Notes, okay, so financing, if I have the cash, makes sense when? Like what are like maybe 2 to 3 bullet points you would give our listeners?
If it's going to be a tax optimal decision. So financing can make sense if it gives you the wiggle room to not have to realize capital gains at a high bracket. And I think if the after-tax cost of borrowing is lower than my expected return, that's a great one to think through, certainly. What else would you add, Jared?
Yeah, I would say if it reduces my if it defers my taxable distributions in high income years to lower income years, it's worth considering. If my after tax, meaning the total cost of borrowing implicit of explicit and implicit costs is lower than my expected return, it's probably worth considering. And then the other thing I would say is if it gets you over the purchasing hurdle, right? Like a lot of our clients have trouble spending the money. So like if it takes the sting out of like, oh, I'm more likely to book that trip if that I know I can afford, but have a hard time booking if I can finance it, right? If they like, it'll ease the sticker shock or invest in that family vacation or in, whatever it is for you that you can afford, but have trouble getting over the hurdle to spend. I would say if it scratches that itch of like taking the sting out of it and helping you get over the fence, regardless of cost, I think that's really kind of a compelling reason to finance.
Jared, I want to give a specific example there. We have had kind of a surprising number of clients. We have had multiple clients that have hit retirement and they've met their financial goals, and they've always had a dream of buying a specific car. And it's typically a pretty expensive car, right? So it's not something that when you're raising kids and you've got all these expenses, you've got a million reasons to say no, right? But you've hit financial independence, you are there. And guess what? It's still really hard to pull the trigger and get the car, even if you can't. And so I think there's a huge amount of merit to what you're saying, that, hey, if financing just allows you to opt in and say yes, I think that's a great thing.
Awesome. Well, yeah. Well, hopefully that was helpful as you think through, hey, if I can, afford to pay cash, when might it make sense to finance? That's where we'll wrap it up for today. Looking forward to seeing everybody next time. Ideas for future episodes, podcast@brownleewealthmanagement.com. Thanks. See you next time.